healthcare is a venture backable, sector. I think is very much still in its infancy, and I think it's really only been like a solid decade, maybe a little bit more of that, and really the last last 5, 10 years that we started to see just generally a lot of healthcare dedicated funds prop up.
Welcome to Venture Voices, where we interview emerging managers within the venture ecosystem. I'm Richard Kerby, and today we have the pleasure of having Sean Doolan from Virtue. Sean, welcome.
So, Bridge, how you doing today?
I'm doing well, man. Thanks again for making time. Looking forward to diving into all things healthcare with you. And one of the fun questions I always like to start off with is, why did the GP pick the name, right? And so, how did you come up with Virtue as the reason and the brand to kind of build this fund around?
Yeah, it's funny. I actually thought I was going to get asked this question quite a bit when I started Virtue back in 21, and I think you're like the second person who has actually asked me that. So I wanted effectively like I wanted a name that could stand on its own. That was a powerful name that resonates, and frankly probably also didn't require like ventures or capital or even partners slapped on the backside of it. Virtues, when I think of virtue, I think about excellence, but I also think about excellence from a certain moral, how we carry ourselves on a day in day out basis. I think for what we do, right, like venture is very much a people and relationship driven business. It's built over a long duration of time, and so how we treat people and sort of conduct ourselves day in day out, super important. I'll sort of kind of a nerd when it comes to maybe like the four cardinal virtues. Those always sort of like stuck with me, and I actually think they map pretty well to to what we're doing here and to what we're doing in venture. So I'm gonna think of like the four virtues like prudence, basically like judgment, ability to discern right and wrong. To think about that from like a selection perspective, like who do we choose to partner with or allocate our LP capital towards. I think about justice, effectively the ability to be fair, again, be respectful of others. Fortitude, that one's probably the most obvious, but just like from a pure grit, like ability to sort of constantly take steps forward, make positive progress even during challenging times, and then like temperance, and so self control, moderation. I think about that here from an investor perspective, like our ability to stay grounded and sort of steadfast, keep our sort of eyes on the prize. Those are obviously sort of useful attributes and helpful attributes as an investor. So win with virtue, and this is probably I'll end with this, like my first time to ever say this on like a more public forum. It's just virtue. It's not virtue VC or ventures or anything like that. So appreciate you asking.
Yeah, no, it's always great to hear the background, and I think all the definitions that you threw out there are also emblematic of what one should want to strive for when part of founders, and
Yeah.
hopefully your founders resonate with that. And I think they have, having spoken to a couple of them at this point as well. And so I know many folks know that prior to founding Virtue, you were at GFC, and so. But not many folks know what was Sean doing prior to GFC, and so it'd be great to just get some context. It's like, was there a world before GFC in Sean's life? Because the internet doesn't show it. And so let us know what was happening.
There was. I did exist prior to GFC. A couple of years back, I just kind of took off that prior record from my LinkedIn, and now it's sort of it seems like it's created this unknown. So, yeah, I did undergrad at University of Michigan, studied econ. After that, I actually spent the first maybe 4 or 5 years of my career in the energy industry. So I was initially, this was like post Enron, trading the price of electricity in the Midwest and West Coast or East Coast markets. Really sort of like enjoyed that space, but then I went to like the renewables side of the house. So really development of large like utility scale wind and solar farms. This very much sort of coincided with like the clean tech boom, and I really enjoyed that that space, and I liked it, and for a number of different reasons. But man, if you think in healthcare the timelines are long, or it's difficult to build projects. I mean, these were 10, 15, 20-year projects that required so much sort of regulatory hurdles. Maybe working in states like California, trying to negotiate with landowners where the land has been in their family for so many decades and generations. And I liked it, I didn't love it, and I think when I was in my mid 20s, I really sort of recognized that like valued my health. I was starting to value my health more and more. Sort of saw my health as fundamental to what I do. The only way I could be sort of the best version of myself, best son, best husband, best employee, whatever that may look like, is if I had the best health, and I could just be able to show up on a day-in-day out basis. And so I got really interested. It started from like a personal health perspective. Then I got really interested in other people's experiences with their own health. I had a friend who was a lifelong sort of type 1 diabetic, understanding sort of his journey throughout those years. An aunt of mine who was a lifelong drug addict and alcoholic. Frankly, seeing her experience, which was like really difficult to see, but her ability or maybe lack thereof to be able to access certain like clinical and social and community services really sort of resonate with me. And so then, quickly, I'll spare you the details. I got really interested for whatever reason with not just like our own sort of our health, like a personal health, but how that extended to the relationship we have with the broader U.S. healthcare system from like a delivery and financing perspective. I really took to sort of like the complexity, the sort of the puzzle that is the U.S. healthcare system, and then sort of marrying that with maybe some prior professional sort of interest with respect to like commercializing early stage technologies, but now in healthcare. And so I still wasn't really quite sure what that meant, quite frankly. And I decided to, if I was going to make a hard right from energy into healthcare, I should probably get, either go straight into the space or maybe I get a sort of graduate education training. I actually went back to U of M. So grew up in Ann Arbor, went there for undergrad and grad, was not expecting to do so. Got my graduate degree there in Master's of Health Informatics, which for all intents and purposes is sort of, thinking about technology and commercializing, healthcare technologies. And then I went to, I think, a really special place, a sort of a right time and right place, which was startup health. And so to kind of rewind back to like 2012, 13, 14 timeframe, digital health, and probably get into some more. So it was just getting off the ground. Like that term, digital health, was just being coined. There was a lot of excitement in startup health based in New York, Rock Health, maybe based on SF, or these sort of initial accelerators and pre-seed funds that really served as these like incredible platforms to sort of carry the torch for this budding digital health industry. And so I kind of got into the healthcare, health tech, digital health space sort of at the ground floor, and built this sort of hyperconnectivity with literally hundreds and thousands of founders. A lot of the early investors, they were sort of the bigger platform style funds at that time, and a lot of folks from industry, so hospitals, health systems, payers, farmers, self-insured employers. How they were thinking about strategically partnering with these early stage companies, all the way through more M&A considerations, and sort of going through that experience. And I was listening to this pod actually with J Cal the other day. I don't know how to pronounce his last name, so I'm just going to call him J Cal. Like I know him. And he talked about how like being an accelerator is like a great starting point, oftentimes for an investor. I totally agree, right? Because you just literally would have thousands of decks and pitches, coming in on an annual basis, and be able to quickly create sort of frameworks and heuristics, lines of thinking to be able to get to that top decile. It's extremely helpful. And then I got the investor bug, like the pure investor bug around like 15, 16, I think. I joined a small first time fund, $25 million fund called P5 Health Ventures out of Connecticut and New York. And frankly, kind of two things happened. My sort of reps in terms of investment reps, like went way down. However, I didn't fully appreciate at the time. Uh, I learned how to form a venture fund, right? And so, was hoping to, raise capital, to, establish, vendor relationships on the fund admin side with legal, banking, sort of tax and audit, putting together CRMs, like all that sort of like unsexy stuff that you definitely know, right? Goes into, launching a venture firm. I kind of got that, firsthand experience. But ultimately, like that was a very formative experience. I just wasn't really getting we weren't really making a ton of investments. I wasn't getting, I thought like the sort of reps I needed to really sort of, sharpen my, my investor iron, I suppose. And then I got a call, from some of the folks over at GFC, and they had just raised a pretty sizable fund, and we're looking to establish a healthcare strategy, U.S. based healthcare strategy, and looking for someone to lead that strategy. So can sort of talk about that, but it was a really really intriguing opportunity, kind of sink or swim, quite frankly, where I could sort of have full attribution in many ways to put a lot of the lessons I had been learning and seeing and sort of frameworks I've been developing to work with respect to developing a portfolio of my own, as well as like really really sort of being on the hook for um, the entire investment end-to-end investment strategy, from the sourcing, the diligence, the winning, the sort of value add post investment. And so yeah.
No, that was super helpful. I think lots of things to pull out there. One, I think great in the fact that you're able to, or were able to, I should say, go from focusing on something that you liked and leaving it and abandoning it for something that you love. That being healthcare. I think you mentioned a hard pivot, from called energy into healthcare, but I think one of the big kind of traits that they really have in tandem are how regulatory they are. Right? There's so much regulation in both those categories that I'm sure there's lots of overlap in your thinking that you take from those days that you apply within the healthcare framework, despite them being very different industries. Um, and then, yeah, I wouldn't be remiss to say once again, at least on video, congrats on the U Michigan victory this year, because I know you were really loving it down there in Texas with
Yeah.
your significant other who's very very pregnant, and so I'm glad you all got to enjoy it.
We're gonna, soak that. We're still soaking that up as much as possible. So if we have to wait another 30 years, I'm gonna make the most of it.
There we go. There we go. And we're going to get into the focus of virtue here in a second. But one last question on pre-virtue is how was it just spinning out of GFC? What was that process like? And what helped you? What hurt you at that time frame?
Yeah. So in many ways, I I do think I had like some unique experience prior that helped prepare me to launch my own fund, right? Basically at that point had thousands and thousands of pitches, so I got a good sense of like what good, great, excellent looks like. In the space, had pretty strong like network relationships, whether it was in founders, co-investors, and then in industry. I actually didn't have any LP relationships, and then starting to had some experience like around sort of what that looked like to not just like launch a firm from scratch, but to also like own, in many ways, an investment, practice and strategy, and sort of, what that looked like and felt like. So in many ways, I thought like I actually did have like a kind of unique, preparation for that. Said, like, you're never fully prepared, right? Like if I sort of look back, 2.5 years ago, and sort of like, ask myself if I knew what I knew now, like would I do this? You know, I've learned so much. I don't know if I have a PhD in how to launch a fund, but I've earned like at least a master's degree or two in the last couple of years, especially with the SVB. And just I mean, there's so much stuff. But then I would say like GFC in particular was like a really interesting platform, just because I think it really sort of for a certain type of individual that was fairly, I would say, independently minded, able to sort of will the kind of portfolio, a portfolio into existence, and had pretty high ambition. It was a great platform to launch from. Wasn't for everyone, but I thought it was like for me, it was incredible experience. Really sort of accelerated my sort of learnings of how to be a better investor in the space. Definitely sort of accelerated, I think, my profile in the space. But hey, let's take a step back. Going into late 20 and early 21, it was, I don't think, I am special in saying this, but it felt like, hey, we're sort of like 10th, 11th hour of the party. Like the music's going to stop sometime, and probably sometime soon, market wise. And 21 was a phenomenal time to fundraise, probably not the best time to invest. And, I'll be totally candid. Like, I thought there was a very real window of time and opportunity to be able to launch this firm that I saw was lacking in market, and coupling that sort of with experiences I had learned in the previous, call it better part of a decade, and without having these sort of decade or 2 decades worth of track record in DPI, yeah, you were able to do that in 21. And so my view was, all right, go for it. Get this fund in the ground, and if we can sort of execute on strategy thereafter, we can be in a position to then execute on a multi-fund strategy thereafter. Um, I think that's somewhat working, right? Like I don't know if I'd be able to launch Virtue right now, if I'm being totally honest with myself. And so I can be humble enough to say it's like, hey, there's a great time to go do that. And obviously far fewer funds are being formed today.
Yeah, that's helpful context there. And I still think Sean Doolan can raise a fund today if it's a fun one. But yeah, I get your point around the market dynamics now being quite difficult for any emerging manager, regardless if it's a fund one, two, three. It is quite challenging, and I think unfortunately for folks, probably will be for some time. Um, and yeah, I guess for folks who are listening who haven't gathered yet, Virtue is a healthcare focused firm at the early stage, and so one question that I thought was very, very interesting after talking to one of your LPs, Graham from Sindana. He noted that there's so many dedicated seeds funds for other big markets like fintech and others, but there doesn't seem to be nearly as many dedicated seed funds within healthcare, despite healthcare being one of the largest markets that there is in our country. And just curious, why do you think that's the case?
Yeah, it's a great question. Graham has asked me this as well, and a number of LPs have asked me this as well. So I suppose maybe a good time to maybe address this, but um, maybe just to address sort of like directly and head on first and foremost. I do think there's maybe some backstory that's helpful here, but there are, I would say, quite a few dedicated healthcare pre-seed and seed funds that exist today, but they can, like, I've been very surprised. Like I will learn about a new fund, it seems like every other week at this point. But I will say in healthcare, right, there is just so much surface area in terms of like, what does healthcare mean. And we've been seeing maybe a number of funds that probably look like us that sort of are focusing on this business of care, but man, I've also been seeing, a number of funds that might be, even more specialized. So whether it's like focused on like mental behavioral health or oncology or women's health, consumer and health, and more sort of wellness oriented funds that would very much sort of sit underneath that sort of broader healthcare umbrella. And then there are a ton of seed funds that I would say that we know of and that we're friendly with and we definitely co-invest with that are I guess by definition not dedicated, but are allocating 30, 50% of their AUM towards healthcare. Um, there's a ton of surface area in healthcare, right? And so I the longer I do healthcare, the more I feel as if it is almost necessary. I think it is necessary to be doing this on a 24/7 basis, just because the types of companies that we see just within our portfolio are so can be so distinct and uncorrelated from one another, right? So we have 17 portfolio companies. If an LP asks us, if Graham asks us, like, what does success look like? Series A success look like for your portfolio? We would have 17 different answers, and so I think historically it's been easier to sort of wait until the Series A to see sort of bubbles up and sort of gets beyond that sort of malleable 0 to 1 stage, and then partner with them at a Series A. But I think one thing that's like I would definitely stress though is healthcare is a venture backable sector. I think is very much still in its infancy, and I think it's really only been like a solid decade, maybe a little bit more of that, and really the last like these like last 5-10 years that we started to see just generally a lot of healthcare dedicated funds prop up. So like some of the maybe the more prominent ones over the last couple of years that have popped up, you see like Defined Ventures, and NSF. They've now raised, I think, like 500-600 million AUM across 3 funds. They formed in 2019. Transformation spun out of Sequoia. They're Boston based. I think they were formed in 2019, but got something like 700-800 million. And then other sort of Boston and Nashville based dedicated funds. Those are healthcare hubs like Flair, Fritz Cressy, Health Velocity. They were all formed in like 15, 16, I think 17 timeframe. And so, it wasn't up until quite recently that we started to see this sort of like almost like scaffolding, in the mid stage of this sort of Series A, Series B market the growth stage firms like the Besmers and NEAs, they existed already. They're already sort of active. And now I think it's very much we're seeing a really opportune time to have a more like developed and comprehensive class of dedicated pre-seed and seed healthcare firms like Virtue that can be like positioned at the top of the funnel and really serve as a trusted signal to the downstream market. But I actually, if you wouldn't mind, I actually do think there's a bit of a sort of a quick look back um, to sort of acknowledge like how we even got to where we are today, because the healthcare in the last like 20, 25 years, I would say, and I only know healthcare, right, Rich? So, I can't necessarily speak about like energy or fintech like you can in some other spaces, but I think healthcare very much has been sort of like uniquely affected and impacted by certain like regulatory shocks to the system. How that's affected like technology adoption, and there have been certain social and cultural experiences that I think have fundamentally reshaped our collective trust with the healthcare system that is informing how we invest and like why we think there's a crucial need for a like high signal, high trust, firm like Virtue, who can sit at the top of the funnel and work with those founders as well as downstream firms. Um, so like I promise not to go maybe full Putin on you and give you like go back like 1,000 years, but I think it would
Sure.
like be helpful. Yeah, yeah. So like late 90s, 2000s, right? Basically, we sort of look back and we see this era as like a era of like just pretty significant consolidation on the sort of healthcare IT world, right? So we saw like a lot of the leading, incumbents who are pretty massive companies today, like a Change Healthcare, or like a Cotivity or, a Azellus, whether in the, claims clearinghouse, payment integrity, claims editing spaces, they might have massive market share today. These were largely built up sort of like through a lot of acquisitions and roll-ups like during that time. And so we look back at that era, and we look at how that maps to like prominent companies today. I actually think like right now that does give us like a really interesting sort of example that hey, you can like scale and real sort of revenue potential with these healthcare IT companies, but also maybe provides us a way to sort of rethink how we can today maybe take market share from those incumbents that have been built on old and legacy like tech stacks. So that was kind of happened in the 90s and it's sort of early mid 2000s. But then sort of like towards the late 2000s, I think I personally think we started to see around 2007, 2008, almost like a golden era for venture backed healthcare businesses. So these were like pure software companies largely. So Viva's the darling, right? Sort of commercial and R&D software for life sciences, formed in 2007, only raised 7 or 8 million and sitting at 35 billion market cap today. You had companies like Cover My Meds, prior auth software for specialty drugs, raised 5 million, sold to McKesson for over $1 billion. You had Greenfire, a payment platform in the clinical trial space, similarly raised 7, 8 million, and sold to Thoma Bravo a couple of years back for over $1 billion. Greenfire, interestingly, the founder and CEO, Sam Whitaker, is now the founder and CEO of Mural Health, which is a portfolio company of ours, basically building a better, faster, stronger version of Greenfire. And you look at those companies, who are they backed by early days? Like they didn't take a ton of venture capital to have these outsized, return profiles that are, so, compelling to us as investors. But it was like firms like Emergence and Viva or Firstmark and Greenfire that got into those cap tables because like a lot of those dedicated firms that we sort of were talking about a couple minutes ago, they just didn't exist just yet. And then all of a sudden, sort of like 2009, 2010, we had this like massive shock to the system in the form of the Affordable Care Act. So, as Obama's massive sort of watershed policy, it fundamentally reshaped our healthcare system, right? Mandated insurance coverage for individuals, catalyzed like value-based care. So, tying payment to the quality of that care. It accelerated adoption of high deductible healthcare plans. It really sort of increases like consumerization of healthcare. Actually, the year before we had the High Tech Act. What that did was it prompted the adoption of these massive both cost from a cost perspective and use perspective, electronic health records, EHRs, and hospitals. So we went from hospitals in the US, hospitals and systems, I think like a 10 or maybe 20% adoption of EHRs in 2008, getting to 75, 80% in just 6 years. Like that's a much faster adoption cycle than what we saw with personal computers and with the internet. And so like that totally changed the game in many ways. Like at this time where we're also seeing these really, really compelling software businesses like the Vivas and Cover My Meds and Greenfires getting off the ground. And then everything changed after that. So that's like when I got into the space, started around 2012, 2013. We sort of look at that as like the digital health 1.0 era. You probably remember that. It was like a really, really exciting time for our space. There was a lot of a buzz and excitement. Everyone was defining digital health, quite differently. Um, and we saw just the amount of dollars like pouring into the space, like really, really increase. So we went from like I think like half a billion in total healthcare venture in like, the mid late 2000s to, 7, 8x and upwards of like 4 to 5 billion by 2014, 2015. We started to see sort of like investment categories that were, I would call like healthcare light investments, more consumer facing, less regulated, like consumer engagement. So we saw like ZocDoc or like in the wearables and biosensing like Jawbone, personal health tracking like 23andMe get off the ground. And it was an exciting time. Like I remember those businesses, but I think frankly, they also maybe lacked, durable, business models. Quite frankly, I think we've been able to learn from that. But we shout out to some companies that were born in that space, like PillPack, in Flatiron, that sold for a billion and 2 billion, and those guys are total rock stars. But there was a lot of like throwing at the wall, and then like what we saw sort of like in the early 2010s and like I would say mid 2010 through 2020 was what we refer to as this era of like the rise of care delivery from like a managed care B2B and DDC perspective. And so from going back when we look at 2000 to 2010, sort of like we're talking about a lot of the software from like consolidation or just like net new company, the quote unquote successful healthcare companies, if we were to define them by like exits or private valuations north of a billion, were about like 65%, software businesses that were, improving how we finance, underwrite, pay for care. They were data businesses. Only about 35% were delivery focused. That flipped from 2010 to 2020, where about 60% of the successful healthcare companies were, fairly capital intensive care delivery businesses. And so we saw, I would say, three distinct types, and I'll shut up after this, but we saw like these three distinct types, which were like the early value-based care providers, like they were, selling into, insurers, partnering with hospitals and systems like the Oak Streets, so primary care for Medicare eligibles, raised 400 million, over 400 million, I think. Village MD, primary care, VBC enablement, raised half a billion. City Block, serving underserved communities, raised almost a billion. But even like the employer-facing care delivery companies, like the Omadas, the Livongos, the Swords, the Hinges, and MSK, like all these companies raised anywhere from 200 upwards of $1 billion venture capital. And then D2C, right? We saw Row and Hims. I think those are really compelling businesses, but raised. I think Row's raised a billion. Hims has raised a couple hundred, prior to IPO, and so like that interestingly, like my takeaways coming out of that time frame was like a lot of like we saw a lot of healthcare infrastructure built during that time by way of sort of like significant amount of these sort of care delivery assets were built and pressure tested that we can learn from. Like from how do we learn from the operating models to like how do we learn from like how do we best underwrite and capitalize these businesses. But again, like they required significant sums of capital, and they benefited from operating in a venture era where that capital was cheap and plentiful, right? So like I actually don't know if we're going to see that again anytime soon in the same way, shape, or form. But it is right. What I noticed, like whether it's talking with LPs or maybe some like friendly co-investors on the more generalists who are coming into healthcare, the connotation that they have with healthcare venture really ties to this era, which is it takes a lot of capital to build these businesses, and it's almost always what they refer to as healthcare is like a care delivery model. We think there's a far bigger sort of opportunity set to invest behind in healthcare beyond just the care delivery, and that's part of the what we're after here. And then and then obviously COVID hit, and that's a whole different story. But I think there are a lot of reasons to think that like today in 2024, it makes a ton of sense to have a dedicated healthcare seed fund because a lot of like the low hanging fruit is gone. It's been picked over. So like the successful playbook like D2C and those like employer benefit focused care delivery models, like they're known and they're heavily saturated. So what we've seen just in the last 2.5 years, building out Virtue is like domain expertise and an adequate depth of domain knowledge around sort of like networks and different buyer relationships, maybe incentives is critical. I don't think this is particularly controversial, but like the engineering costs in these companies, cost of compute is just like continuing to go down. I think that's going to very much accelerate the next couple of years, and so just less venture dollars are going to be required to go into some of these businesses, and we're still seeing the shakeout in the overall venture market where is we are correcting, right? Like, I'm sure you're seeing it, on your side, but like a lot of our friends and our like co-investors or follow-on investors in those multi-stage firms, they're starting to retrench back to their sort of like core Series A and B focused rounds, and we're seeing a lot of like the seed stage, generalists maybe retrench back to like their core sector strategies, or maybe they're migrating into new sectors like defense and art tech, which is great. But the current perception is like in early stage healthcare is like a lot of the tours like, and I think that's like a negative connotation, but they're gone, right? And so there is like a certain arc, I feel like, to how we got to where we are today, why it matters, like why I think it's pretty helpful to know how we got to where we are today, and that how that may inform what we invest our LP capital towards. But also recognizing that like we're living in a fairly dynamic venture market right now. That I personally believe, I'm clearly biased, I'm sure you are as well, that is sort of bifurcating between the mid later stage platform funds and these sort of like boutique artisanal pre-seed and seed funds where expertise specialization is going to be critical to drive alpha.
Yeah. Yeah. No, the last point, you have definitely strong viewpoints on boutique versus large funds, which can be another podcast on itself. And
Yeah.
I'll make sure I put the focus back on Sean and Virtue here. But no, it was really great to get that, kind of history lesson on, call it late 90s through today on what's occurred to create things in the category. And yeah, you're right. I mean, I think all those evolutions you mentioned led to a renewed focus on value-based care, a renewed focus on employer benefits, a renewed focus on just like employers becoming more and more self-insured in our space, and then
Yeah.
just creating new opportunities on both the payer and provider side. And yes, we saw the DTC side for the actual patient as well. And so lots to go on. But I think the maybe summary point for myself there too is just there's a reason for Virtue and maybe other virtues to exist because one, you mentioned at the very beginning of our call, the podcast, I should say, that the surface area is so large, but it's not only so large, but it's so complex, right? And so oftentimes you're not going to see, maybe a virtue might spend time looking at value-based care, but may not spend time looking at therapeutics, drug discovery. And so lots of complexity across the chain here. And there actually are enough surface area for folks to be even more narrowly sliced within healthcare itself. And you mentioned in the call it previous, you think you called it the 1.0 wave, the successful companies within healthcare that were software based were generally funded by generalist firms, we'll call it. So, how do you think about that dynamic into, the rounds that participate in from a virtue standpoint? Do you find that founders still want that like strong brand name on their cap table early on and say, yeah, Sean's a smart dude, but like, I don't know what virtue is. Or do you find them gravitating more towards the seed focused firm within healthcare, or do they want a combination, right? And so I'm obviously leading the witness here with the question, but nonetheless would love to get your viewpoints there.
Yeah. We should find you a role for our cap formation team going on a fund too. I like your talking points. You do a better job of fundraising probably than I do. So, our experience, like, well, first and foremost, just at our current fund size, we're just over 30 million. We're not probably going to step up, significantly from there towards a fund two. so say we're between 30 and 50 million from a fund one to fund two perspective. I think that sizing allows us to play well with others, right? Like we can lead, we can co-lead, we can follow. I think we have led and co-led almost just over 2/3 of our deals so far, which frankly is a bit higher than I was expecting. But what I find is the a lot of founders, there will be some, right, that naturally gravitate to a certain brand, and there's nothing we can do about that. We're not ever trying to compete against a founder that maybe wants a certain established and recognized brand. Frankly, I think from our experience though, that is typically like a first time founder who may or may not be optimizing for the right things, but hey, it's fine. That's fine. We invest and co-invest with those types of firms. But man, Rich, like this, I feel like you know one thing that sounds so obvious, but has really served as such a catalyst for us to be able to partner with those, most exciting teams is being able to step on a call and, you got a 20, 30-minute intro call. And, on the other side of the table are these, founders who they're grinding, right? And to be able to sort of meet them where they are at and to not have to speak at a sort of 50,000-foot view, but like by way of both being able to speak a common language, because all we do on a 24/7 basis is live in this sort of healthcare land. We breathe healthcare, and to be able to speak in a common language, understand what they do, understand the market opportunity that they're going after, and be able to develop a sort of immediate trust and rapport by way of having a fairly tactical and strategic conversation in that intro call. I've been surprised at how many times that has elicited some sort of response from the founder where they just say something along the lines of like, man, like I can't tell you how refreshing it's been to, be able to speak, in detail about my business and how I'm thinking about this and how I'm thinking about risks, to the business over the next, 12, 18 months, in order, prior to Series A. And so that helps a ton, a ton, a ton. And I would say, beyond that, like we're starting to see like increasing compounding advantages because we do just have a sector focused fund. We have companies that can partner with one another. We have a lot of shared networks and lessons learned within the portfolio that they can share amongst one another. Obviously, we can do the same with our portfolio companies. That's clearly that is an advantage of ours, and we're looking to really double down on in sort of the second phase of virtue. So those things help. They're not what's ever going to win us the deal, but you know, being able to understand sort of like how we think about it, being aligned, how we build that business, where we sort of identify those sort of like key risk profiles that we need to be able to address prior to Series A and sort of operate in lockstep, almost coming out the gate when we meet one another. That obviously helps.
Yeah. No, I think something I noticed too is that when you're able to say to the founder, hey, those first 3 or 4 slides where you're describing your market opportunity or what the category you're working in is, just fucking skip them.
Yeah.
We understand it. Let's just dive right into it. And I think it makes for the efficient call, and the folks are like, cool, I don't have to like educate Sean. Now instead of a pitch, it's a conversation about folks that are very interested in XYZ form of healthcare.
Yeah. Yeah, we can typically gloss over the market and TAM
Yeah.
dialogue. I would say too, like, and you know this, over equal, but like the, I think if you're a specialist of anything, whether it's a sector, a technology, something like a marketplace model, or even a geo, it's just as important to. I think it's just as important to acknowledge like and know why you're saying no to something as it is to why you're saying yes, right? So like the amount of like rev cycle RCM type pitches we've gotten over the last couple of years and why maybe we've taken only one or two positions out of like literally the 200 300 pitches we've gotten, or why maybe we didn't and this is predating virtue, but like why maybe we saw the sort of up and to the right revenue profiles from some of those like pandemic virtual care businesses prescribing Adderall and Ritalin, but knew this isn't going to last, right? And I think that's an important attribute for that specialist in our in for us. It's like, what are we saying? no to as much as like what are we saying yes to.
Yeah, yeah. And maybe switching gears here for a second, it'd be great just to get a sense of what's the team makeup at Virtue today, and do you want to scale the team larger or not? And that'd be helpful to kind of get a sense of what is Virtue today and not and in the future from a just a team bandwidth perspective.
Yeah, totally. So right now it's just the two of us. So it's myself and my colleague, my partner, Emre Karadish. So when I launched Virtue back in 21, it was just me. But frankly, I had no intent to build and scale Virtue in a solo capacity. Emre was a fellow investor in market who I just had built a relationship with for the over the previous like 4 or 5 years. Just incredibly smart. I mean, he is so damn sharp, really, really, good guy, and doesn't stop working. So it's like, best combination. But it's him and I right now. We sort of, run Virtue, just the two of us. I think moving forward, I think, or maybe generally, like I tend to believe, especially early stage pre-seed and seed, strategies, a concentrated team is advantageous relative to a larger, sort of more bloated team. I just think, more people, more process, less ability to go win that best deal. So, I'm talking with folks. I'm always trying to, get a sense of where, talent is in market. Do we add a potential, third investor and team member for fund two? But, I'm not sure. I could probably go 50-50 on that. But, regardless, say we earn the right to get to a fund two and fund three and sort of execute on a multi-fund strategy, it's probably safe to say like we will always be having a running with a fairly concentrated team size of maybe no more than three, four, five, but it'll be tight and small for the foreseeable future. I also tend to believe that pre-seed and seed sort of sub 50, sub 100, definitely sub 50 strategies. Um, you're going to see the ability to do far more with far less, and so yeah, we'll keep it small.
Yeah, no, I'm agreeing with you on lean, particularly for the boutique like model that obviously you're operating in Virtue, and so that makes a ton of sense. And you alluded to the fact, hey, I started off as a solo GP. I'm not the only person though working at Virtue, and so I think there's also just I was talking to another LP actually a couple weeks ago, and there's a delta between being a solo GP and a solo capitalist, and those are very different things. And you're obviously more in the solo GP versus solo capitalist camp. And so, with that said, you did start solo. And so, how is an investment decision made? Is it Sean saying yes? Is it Sean and Emery saying yes? Just Emery and Sean can like say maybe. How does that actually work internally for things to get across the finish line for you guys?
Yeah, it's just the two of us, right? And so I think there's a lot of strength in the two of us right now, in the sense of like we can produce a better investment decision when we're both engaged, right? So ultimately, final investment decision does rest with me, but like the 99% prior to that sort of final decision, we're tied at the hip. So it may not always be the case that like we're both on a first call together, right? But by a second call, like you better believe like we're both on, and we're both pursuing from a sourcing perspective, from a winning perspective, together. I think we also bring maybe complementary skill sets to how we assess and evaluate companies. Emre is just he's extremely sharp, and he is, I think, really, really good at sort of diligencing and sort of evaluating a lot of like the what. So like from a product, from a model perspective, and really getting into a lot of sort of tactical detail on that side. For me, like I like that. I am also, I would say, fairly market driven, like really, really wanting to understand sort of certain dynamics in a market where there is sort of non-obvious or maybe non-obvious pull or just sort of misunderstood markets. And then ultimately, Rich, I'm a people-driven pre-seed and seed founder, and so I spent a lot of the time sort of like trying to really understand the sort of the why and how of that management team, of that founder, sort of like what is motivating them, what's sort of like pushing them, but also I think the how, like how can I get comfortable with their ability to operationalize and sort of realize what is an exciting idea. And so I would say we have there's a bit of overlap in what we look for in deals, but there's also a bit of a, quite a bit of a complementary nature that we kind of bring together. But I mean, when we lock in on a deal, and that's typically by a second call, we are operating, together in tandem, and just, really, really honing in on trying to, get to conviction as quickly as possible.
Yeah, yeah. And I think that that goes probably to the point of my next question, actually, which is, I know you kind of tell founders, hey, we're going to get you an answer in 7 to 10 days after that first meeting. I imagine there's a number of reasons why you can do that, and I'm sure there's always happen. But I love the framing of it, at least, because I think speed is a great asset, right, within our world. And then two, as you mentioned, it's two of you, right? And so in theory, you should be able to get to a decision point in quick fashion. And then three, you only do healthcare. There are many things within healthcare, but you
Yeah.
only do one category. And so I imagine the confluence of those three things enables you to at least propose that timeline to founders. Whether or not you stick to it is a different question, but is that fair to say? And how do you use it to your advantage?
Yeah, definitely. And between us and now with the audience, I would say 7 to 10 days on the website is great marketing. I mean, hey, we've gotten to conviction within 48, 72 hours on one, maybe one deal for sure. There's also been, we recently did our most recent investment was a function of a relationship that we've been building for and pursuing for 2.5 years. Right. So I would say part of our also like our sector, focus is we're fairly plugged into these like talent networks, right? And so like what companies are producing sort of like the best operators and best talent. So like in New York, right? We saw for many years like Oscar and Flatiron was a great bed of talent, right? Understanding sort of how, like who these people were, how they reference within those, company networks, what they were responsible for at those companies. Like that's all information and pre-diligence we could do way before they even have a concept for starting a company. So I would say like 7 to 10 days why we're able to execute on that compressed timeline is often, not always, but often, like there's quite a bit of pre-diligence we are able to do on the actual people, where we've checked off all the boxes on them, and then it's really sort of pressure testing like strength of idea, what that partnership will look like. But I will say, like, you touch on speed. Obviously, two of us, like, speed is an asset. It's kind of been my experience that and it's just my experience. I could be totally wrong here, but speed can inform, I think, a better investment decision, right? Where you're just totally locked in. So for us, we have the initial intro call. You're thinking about that, obsessing about that. Typically, we do a longer 60, 90-minute follow up call within a couple of days. We send a bunch of questions over. That second call is pivotal, right? It either dies on the vine there, or if it's still go, like everything's put aside and we just lock in. And I find like operating with like a sort of a real speed where you are so intensely focused on this company, on this team, on this market opportunity. You're also developing a rapport where like you're texting throughout the day, you're jumping on, unscheduled calls. So you're kind of building almost like a working session, with these founders to get a sense of how they operate and what that actually looks like. Um, you know, maybe it'd be better, we'd be better served if we, extend that to a 2, 3, 4 month time frame. But honestly, we'd probably lose every single deal if we do that, at least at our stage. We don't have the benefit of seeing entire sectors unfold and building relationships over many, many years at then invest at a Series B. So I think speed is both an asset, but also maybe necessary and critical to, our success.
Yeah, no, it's great hearing how you utilize speed as an advantage. Particularly, look, even though there may not be as many dedicated pre-seed seed funds in healthcare, there just are a lot of seed funds, period, and pre-seed funds, right? And so using that as a lever to kind of get to that maybe first decision is super helpful, because these competitive dynamics, oftentimes a founder will go with the investor that got to conviction first, and using that to your advantage is, I think, paramount.
Dude, it never ceases to amaze me, and maybe at some point it'll just totally register. But when you're the first money into a business, you almost invariably will have a special relationship with that founder forever. I mean, I remember who my first LP commit was outside of that relationship I didn't already have, right? Like I will forever remember this individual. They get, all the love from, like, if they call, I'm picking up, and I do love that aspect of like what we do and being first money in. And I think speed does help when you sort of, um, can partner with these folks who are taking all the risk in the world to get to get their idea off the ground.
Yeah, no, being that special first institution mentor is always special for the founder for sure, and for us honestly too, because we feel it as well. And Sean, you alluded to a recent decision you guys made to do a deal, and so it'd be great just to get a sense of like if you don't want to say the name, don't worry about it, but what was the company and or business that you've most recently invested in, and why'd you say yes?
Yeah, good question. We love all of our portfolio companies the same, obviously. So equally across the current 17. Um, Maybe a recent one I'll just choose, and um, would be 32 Health. So 32 Health, based out of Boston, they are building AI and NLP enabled back-end claims infrastructure product for the 140, 150 billion plus dental, hearing, vision markets, and they're providing claims auto adjudication, smart underwriting, plan benefit design, sort of real time credentialing, AI call center, and really a pretty slick sort of unified platform. What we've seen and learned over the years is claims processing in and of itself is a massive a spend bucket in this in our industry, and it's still a highly sort of manual workflow and process in medical for sure, where that gets all the attention, but certainly in these sort of secondary markets like dental and hearing and vision. And so the team itself, like these Shaju and Deepak are I think have a great combination of just being like seasoned dental execs, selling various products into plans, carriers, different TPAs over a couple decades, but also from a technical perspective, like they're build product with the best of them, like really sharp. And then zooming out, like there's a lot of I would say like strong like why now reason. So like if we just look at dental as part of the hearing and vision sort of target, it's massive market. So majority of Americans, well over like 250, 260 Americans have dental insurance. I mentioned like the spend bucket, and the about two-thirds of that through private coverage, the other third through government programs. But we're gonna, there's a lot of talk just at the federal level to start to carve in dental as part of the Medicare benefit. But when we look at sort of the current incumbents and specifically like the TPAs that are really responsible for a lot of these adjudication processes and the carriers themselves, I mean, this is legacy tech 101, right? Where software itself, like was it was written 20 plus years ago, and they're struggling, big time to be able to hire best engineering talent to be able to recruit in and rewrite internal code and software. I mean, it's probably not that controversial that top engineer likely isn't going to Delta Dental, let alone a sort of mid-market, dental or hearing, vision carrier in a, Nebraska or Iowa, right? But these are big groups, right? And so we see that there is a, software stack that is ripe for like true disruption, and pretty strong, I would say, regulatory tailwinds where new policy with respect to like dental loss ratios are basically placing more and more emphasis on the dental premium, and basically these carriers wanting to having a real need to automate the vast majority of what largely have been manual processes with 99% accuracy, which 32 is able to offer. So we think it's the right place, right time, just an N of one team truly who can sort of serve this market, and future is really bright for 32, and we're excited for them.
Nice. No, it makes a ton of sense there. I think the points you mentioned honestly also hit what you said you like to look for, right? And so you've got a team that you think is highly confident over at 32, attacking a legacy market that is ripe for modernization, and three, a category that also just has regulatory tailwinds to them. And so definitely understand why you got so excited about the 32 team. And then I guess you made an investment. Let's say I imagine the focus of healthcare should, in theory, enable you all to be, quite helpful to these portfolio companies. And so it'd be great to get a sense of a scenario in which, you think like your healthcare focus has been helpful post, invested beyond the dollars to your portfolio companies.
Yeah, it's a good question. So I'd say probably one of the most common ways we're able to support our companies is accelerate their go to market, and that is like leveraging our relationships with those individual buyers, and they always come as teams and packages, but those decision makers, most often at a lot of insurers, but also hospitals and health systems and biopharma, to get to that sort of product market fit. And I think that's a particularly important with what we for us and given our strategy, because all right, we are healthcare investors, but we're also seed investors, and these companies don't have infinite runway. Maybe it's upwards of 18 to 24 months. Maybe it's a little beyond that, until they're out of cash and need to be able to demonstrate to that Series A market that there's real product market fit. And so think about the buy cycles in healthcare. It is an industry where it can take some time. It can take 18 to 24 months to be able to get that first contract with a Humana, with a Cigna. And so if we're able to put our relationships to work, and some of these are LPs, we are backed by some of these groups, so that 18-month sales cycle is actually compressed down to 9 months. you know, that is significant when you sort of map that to that 0 to 1 period, where they have a finite amount of time to be able to get to 1 million, 2 million of ARR or run rate. Especially in today's venture environment, right, where like we see Series A graduation rates were as high as 60, 70%. Like honestly, like come on, like it wasn't that hard to get a markup, all right, for a number of years, right? Like you just had to invest, and they're off. They'll be fine by their Series A. But now that Series A graduation rates are falling as low as 15, 20, maybe 25%, and the cost of capital is so much higher than ever before. Um, I this is my my reason for why virtue, but like it's so important, I think, now more than ever, to have a partner who fundamentally understands what you do, what you're going after, who you're selling into, to ensure that you're able to, remain viable, like especially if you require future venture financing. And so I think we're able to, compress certain, feedback loops, as well as, go-to-market loops or cycles, and that's been the case for the vast majority of our portfolio in terms of just like common, I would say the single most common thread across most of our.
Got it. Got it. Yeah. So, fat founders who are listening, expect Sean and Emery to help with the GTM side as soon as that check is wired, probably in advance. And you know, maybe just changing gears completely for a second. I know you've given us a lot of time, and so I want to be cognizant of that. But I saw that you ran a 50-mile ultra marathon. One, what the hell possessed you to do that? And then two, what did you learn from just preparing and ultimately running that race?
Yeah. So I think I was pretty bored in my early mid 20s, and I just picked up running one day. I never thought growing up, by the way, playing sports, like the idea of running without a ball involved was like the stupidest thing I could. I
Yeah,
was never gonna do that. So
I'm with you on that front. Like for me, playing soccer, basketball, and tennis, running was always punishment.
yeah,
Like you fucked up, you were doing suicides, and so like to me, running was always the bad thing.
totally. Yeah, that was like completely foreign to me. But then, I was, found myself sort of in my 20s, and I was just needed. This actually coincided with me getting back into like my health and like prioritizing my health, and so I started running, doing some other things, and then In many ways, I wanted to see sort of what I was made of. So maybe like the masochist in me just like kept on going further and further and further. And I wanted to see how much I could push myself. And that started within 5 miles to 10 miles. And I was like, all right, I'm going to 50 miles. I read Born to Run. I was like getting looped in with like the rituals of the world. And so I ran a couple of ultra marathons, and I don't know if I have one in my near future or medium term, maybe not even long term future, but I have thought about at some point maybe reflecting on all of the lessons learned I took away from ultras, like the training involved, and how to run those races, because there are so many life lessons, and I'll just maybe leave you with one, which is like, dude, these you're probably out there for 9 to 12 hours, right, at a time. Like, say you're running miles and you're at elevation. There's a lot of sort of ups and downs. You're maybe running in heat, and like you are hurting in every single possible way, and honestly, probably more mentally than you are physically, because you might find yourself totally alone for 2 3 hours. You're not even sure if you're on course anymore, and it pushes you in ways that you really sort of find out what you're made of. And like, I just remember my very first race. I was in Bryce Canyon, Utah. It was like a early June, like way. It was like I should not have started with this race. It was like very technical and difficult. And I got to like mile 40 of a 50-mile race, and I just wanted to give up. Like I truly I hurt so bad, man. Like everything was, I felt like I was falling apart. And the one thing you don't want to do in one of those races is get a DNF, like do not finish. And I was seeing just like medics come back, like, and looking for people. And all I wanted to do was stop. But I knew like if I did stop, I was done. Like I was cashed out. I was done. And so I just started telling myself, like in this moment, like, 1 foot forward, one step at a time. I didn't have to run. I didn't have to jog. I just keep that forward motion and positive progress. And I know it sounds super corny, but like I was just telling myself this for like 2 straight miles. It's probably like almost an hour because I was going so slow. Just uh, you know, 1 foot forward, one step at a time. And then like this angel, this big dude, he like was kind of coming up behind me. He was like, "Hey, you good?" We sort of became friends out there on the trail. First time I've met him, haven't seen him since. And we ran back together. He kind of lifted my spirits and everything. And that stuck with me, man. And especially like I kind of feel like I'm sure you got so many of your own stories, but launching a venture firm, we're like 2.5 years into a 20, 30-year journey. It feels in many ways like we're in the early couple miles of a ultra marathon over here at Virtue. And so, whether there were moments like SVB last year when I thought the world was crashing, or we had a time where like we had a big LP need to liquidate because they were having their own issues, and then we had to re-raise a portion of the when the market just was brutal. I know it's kind of cheesy, but like it truly sort of helped me and motivated me to kind of look back and be like, all right, just like one step forward, 1 foot at a time. Like just take it day by day, and we don't need to make leaps and bounds, but sometimes day to day. So yeah.
Yeah, and I mean, I would say also just the journeys of the companies we invest in are also ultra marathons in their own
Totally.
way,
100.
and so lots of, and then I guess I'll leave this one piece here, which I know I kind of already mentioned earlier, but I know you all are expecting your first child in a few weeks, and so one, congrats again on that, and two, for that next phase of your life, you're going to need to go one step forward as fast as you can. And so keep that mindset locked in for when that baby arrives as well.
Yeah, no, I appreciate that, man. We're Michelle and I, we're super excited. We're 5 6 weeks out, and Michelle, as she's a venture back CEO. She's founder CEO. She's far more impressive than I could ever imagine. I could ever expect to be, and to see her run a you know like a massive business, running the board in like week 34 of her pregnancy. It's just like you know it's she's doing God's work. She's like total hero status right now. So
Yeah.
it's super
No,
it's super cool
no,
to see.
I can relate. My wife is also way more impressed than I am, so I can relate to that fact. But and this just to go
Yeah,
ahead, Sean.
I was gonna say it'd be rude of me. I've never done one of these, but I will say, extra shout out to Michelle. The she is the reason why virtue exists. Uh, she encouraged me, she inspired me when I sort of thought maybe I could do it, but wasn't totally convinced. She was like, "You're ready, do it." Shout out to her.
Yeah, no, she was your version of the big guy in the race, but in relation to the venture fund pushing you forward there.
I like that. I like that a lot. I'm gonna, I'm gonna
um, and yeah, just lastly, Sean, I know you gave us a ton of time here, so really appreciate it. And thank you again for making time to show us the inner workings of virtue. It's been great.
Yeah, I appreciate it, Rich. It's been made known to me, especially by some of my LPs, that I need to start developing a brand and a voice around virtue. So, first time we've done one of these. So hopefully, I didn't, wasn't sounding too nervous or anxious, but really appreciate you, highlighting virtue, and thank you so much.
Nano, of course, and you did a great job, and looking forward to doing it more often.
Cool. All right, man.